Good afternoon, everybody. Today I'm going to start a very interesting lesson under the financial economics, that is in our University of Science and Technology, the fourth semester, MEC 402 code number. And it is one of the core paper, and it is very important in every aspect because the financial economics is a part of the uh, implication of all the economic theories. It means whatever economic theories we learned in the first semester, micro, macro, the development economics, all these are duly applied in case of financial economics, and that is why it is very important that we have to know. So in this paper, you will get very important aspects about the Indian financial system. Out of all this financial system, actually Indian financial system is divided into two major groups. One is money market and another is capital market. And here in today's lecture, I will discuss about a part of the capital market which provides long-term finance to the society. The capital market that consists of primary market as well as secondary market. So the primary market is the market where all the new shares are issued, and it is a market where a company, when they try to borrow money from the market, they issue share and sell it. And another part is the secondary market, which is whatever shares are sold in the primary market, that is resold again. Because if somebody buys some share, after a few days, if he observes that the price of the share has increased, or if he or she is in urgent need of money, then in that case, he or she may sell it. When that person sell it through the share broker, it goes to the stock market. And suppose another person, if you want to buy share, that person, that second person, he didn't have money while the company issued new share. Now he got some money and wanted to invest in the capital market. He will now go to the stock market, secondary market, which is known as stock market. So today I'm going to discuss about the stock market, how it works, what are its different things. So let me share the screen here now so that everybody can see here. So at the very beginning, what is stock market and its role and function in economic development. Next, we are going to the next slide. That is, what is a stock market? The term stock market refers to a market in which shares of publicly held companies are bought and sold. Such financial activities are conducted through formal exchanges and via over-the-counter market places under the framework of defined set of regulation. And one important thing that you must know, that the capital market is totally controlled by SEBI, SEBI, Security Exchange Board of India. It controls. Likewise, in the money market, the entire money market is controlled by the Reserve Bank of India. So the another authority which controls the capital market, that is SEBI. So whatever activities will be done in the stock market, everything will be under the purview of SEBI. Next is 4 important features of the stock market. Stock markets are venues where buyers and sellers meet to exchange equity shares of public corporations. It is a part of free market economy because the investor have free access to trading and exchange of capital. Next character is stock market creates efficient price discovery and efficient dealings. So it is very important because efficient price, the price must be efficient. It is a controlled price. You have to pay while you buy, you will refund while you sell. Everything is done in this market with a systematic manner under some jurisdiction. Next is stock market is regulated and controlled market. It is totally regulated and it is totally controlled because Whatever rules are set by the authority, that's I just told you as a while back, SEBI, everything will be carried out under this jurisdiction. Next is difference between stock market and stock exchanges. Stock exchange is an organized market for the sale and purchase of securities such as stocks, shares, bonds. Traders in stock market buy or sell shares on one or more of the following stock exchanges that constitute our all stock market. Because there are different kind of stock market. We have BSE, Bombay Stock Exchange. We have NSE, National Stock Exchange. So the transactions happens in every market as per the rule. Now, difference between the share market and stock market. A share market is a platform where sellers and buyers jointly assemble to trade on publicly listed shares, while stock market trades bonds, derivatives, and forex, means foreign exchange, and both have distinct mode of operation as well. They have some separate set of rule, and accordingly the transaction is done. The financial instruments traded in the stock market constitute shares, mutual funds, bonds, and derivatives. All are. I think you know what is called share, you know what is called mutual fund, and bonds and derivatives, which are a kind of future contract. That is, in other lecture we'll discuss what is called derivatives, what is called mutual funds. That is. Now, kinds of stock market. The stock market is of two types. One is primary market, and another is secondary market. That I told. Primary market, the firm enters the primary stock market following its first time enrollment through the process of an initial public offering. That is called IPO in short form. Many of you might be knowing that this company, that company are issuing some IPO, initial public offering. And secondary market, once the corporation's new shares are sold in the primary market, they are later traded on the stock exchange market later on. Next is, it functions through the exchange traded market, over the counter market. The former is known as auction market. Auction where bidding is happened, because when company issues some new share, the company after issuing new share, the company is to take some broker, the listed broker. That is called share market. Because without broker, we cannot trade, we cannot deal the shares in the market, because those brokers are designated broker, or nowadays it is called share merchants. They are designated by the share market, and there what happens? Suppose company A, it has a new IPO, initial public offering, then it will go to the capital market. After reaching there, they will register and they will they will designate one share broker, and the broker will make the bidding in the market. In that bidding auction, the price is decided. And other is over the counter. Actually, over the counter, where the shares are given in the counter and people used to buy. The former is known as auction market, which is strictly regulated market, and all transactions are done through stock exchange. On the other hand, OTC is an informal market where the two make certain interest through mutual understanding. Financial instrument traded in the stock market. Shares of publicly held companies and mutual funds. Two types of shares are there, namely equity and preference shares. Equity and preference shares. So next one is mutual funds. These are the financial instruments that accumulate huge financial capital from numerous investors. Four types of mutual funds: bond funds, money market funds, target date funds, and stock funds. Actually, you see, generally in the common parlance, a layman knows about the mutual fund, whether he or she may not be knowing about the equity share, debentures, bonds, preference shares. Because the mutual funds companies used to make advertisement If we go to any commercial banks, their public relation officer sometimes may suggest you to invest your money in the mutual funds. Okay. And bonds are debt securities wherein the investor lends out the funds to the government or farms. Bond for a fixed period. Actually, bonds are like that. When a company issue bond, company promise some a certain amount of interest, the company will pay to the bond holder, means who will buy the bond. Actually, selling bond and getting money by the companies, just like you can say taking loan from the bank, that kind of. Derivatives. These are the formal contracts made between two parties that derive their value from the performance of an underlying assets, which may include bonds, stocks, currencies, commodities, market, indices, and interest rate. How does the stock market operate? The stock market is operated under the following steps. First, listing of an enterprise in the primary market through IPO, initial public offering. Number two, distribution of shares in the secondary market. Next, communication between the interested investors and their brokers regarding the number of shares and other instruments to be bought. Relaying the order at the stock exchange at the prevailing market price. Next, delivery of shares or other instruments to the investor account. Next, functions of the stock market. The stock market ensures price transparency. Everything is transparent. Which price having what means which shares having what price, how these are dealing, how many shares are already sold, how many shares are available. Everything is transparent. The stock market provides the basic information to the market participants regarding the nature of the securities, buy and sell orders, thereby helping the process of their fair and transparent pricings of securities. Traders in the stock market include market makers, investors, traders, speculators, and hedgers. How stock markets are regulated? Stock markets are regulated by the local financial regulator or monetary authority or institute. Important of stock market in the development of economy. It is a component of free market economy, especially. You know, you might be saying that India is not a free market economy. India is a socialistic pattern economy. Actually, India is a mixed economy where we have the both options. Because until and unless there is a stock market, big company, how they will operate? To operate of the big companies, because a big company needs a huge investment, and those investment they used to borrow. And most important thing is that these big companies cannot borrow that amount of money from the bank, because bank provides the short-term money. And another thing is that bank has some restrictions. That bank always cannot give its entire money to a certain particular party. You might be thinking that Vijay Mallya has taken a huge amount of money from Punjab National Bank. Nirav Modi has taken, and they flee away. Actually, many times they got some government favor, and that's why. But in general case, it's not possible, because the whatever bank get deposit from the public, bank has to, because there's withdrawal also. People used to deposit money in the bank, they withdraw also. Yeah, there are fixed deposit and other things. Those things you can consider. But important thing is that while a big company will borrow money from the bank, from the next month they have to give AMI. But big companies, when they start a new project, those projects are having a long gestation period. Minimum 5 years it takes. Suppose the Reliance company got some, say, for instance, I'm taking that Reliance company invented a new cash deposit or oil deposit in the riverbed of the Brahmaputra. Now, that project that Reliance got from the government of India. Now, when they discovered, now they have to set up a new refinery or some other installation of the machines. For that, they need huge money. Means thousands of crores of money they need. And that money They have to make a huge infrastructure. To build the infrastructure, it will take 4 or 5 years. After that, they will drag crude oil, then they refine. After that, they will sell. After selling, gradually they will get money. So they will repay the loan. So taking loan from the bank is not possible, because until and unless they start the producing goods and selling in the market, they cannot repay the debt. And that is why it is only possible in case of capital market. So that is, so it is a component of the free market economy. It enables the companies to raise funds from for investment. It facilitates investors to make profit through capital gains and earn income. It encourages more savings and investment, both of which are very essential for promoting economic growth. The stock market induces the flow of resources from surplus unit to the deficit unit, which allows the companies to grow their business, expand new projects, adopt new technologies, and create generation of employment. Of course, a company has an intention to set up a big new project industry. For that, they need money, but that much of money they don't have. So they will drag the money from the capital market by selling the share. So from deficit unit, they try to get money from the surplus unit. What is surplus unit? Suppose you are earning a huge money or a certain salary. After making your all expenses, you could able to save some money. That money is your surplus. You need 50,000 per month, but you are getting salary of 70,000. So 20,000 you can save. When you save 20,000, that is your surplus. And that surplus amount, if you buy the share, it means that the money will move from your surplus to the deficit of the company, which the company need. Now, when company gets the money from the share market, company will set up new industry. Setting up new industry will create new employment revenues. It will make growth. It will make growth and development. So thank you for today. See you in the next class. Bye.